This is Chapter 1, Accounting and Business. This is an overview. These are the objectives out of Chapter 1. To begin with, I'd like you to know who the users of accounting happen to be. To know who the users are, we have to look at two different types of accounting. One is financial accounting, and financial accounting is used by external users. And that's what we'll be doing here in Accounting 201 and Accounting 202. Now, who are external users? External users are investors, they are lenders, they are regulators. And what external users do is they look at your financial statements to make business decisions upon. Example, you might think about investing in a company, so you look at its financial statements, and based on those financial statements, you may or may not invest in that company. The other type of accounting is managerial accounting. Managerial accounting, its focus is that of internal users, or by its very name, managers. So the first objective I have for you is to know the difference between internal users and external users. The second objective I have for you is what are the opportunities in accounting and how is accounting divided up? Accounting is divided up into three basic areas: public accounting, private accounting, and governmental and/or not-for-profit accounting. Now, in the handout that I happen to have for you, that hopefully you have in front of you right now, you'll see that public accounting makes up about 25% of all the opportunities in accounting. Now, what is it that differentiates public accounting from private accounting? Public accounting are normally certified public accountants. They have many clients, and they can render a variety of services, such as tax services, audit services, managerial services. Private accounting, if you're an accountant in private accounting, you don't have many clients. You have the company you work for. Again, in private accounting, names for individuals that work here would be a controller, or possibly an office manager, or somebody that works in the treasurer's department. Last is governmental accounting. And the reason governmental accounting is separated out from the other two is they have different rules and regulations that they follow. Every time that a government agency has a particular function, they have a new what is called fund. And that fund has to be separated out from the other funds to account for the inflows and the outflows. So we have three areas or three opportunities in accounting. That would be public accounting, private accounting, and governmental accounting. I would like you to know the difference between those three. The next is the rules and where the rules come from in accounting. Now, why do we need rules in accounting? Let us say that you are an external accounting user, meaning that you might be, let's say, a potential investor. You're looking at two different companies, say Microsoft. You might want to buy some stock in Microsoft, or you might want to buy some stock in, say, Apple Company, Apple Corporation. And you don't know which one would be a better investment. Well, you will look at their financial statements to possibly make that decision. Now, if the two companies used totally different sets of rules in compiling their financial statements, it would be impossible to compare the two companies. Therefore, we need a unified set of rules. That unified set of rules here in the United States is something called Generally Accepted Accounting Principles. So the third objective I have for you is to understand and know what Generally Accepted Accounting Principles happens to be. Where do these rules come from? There are two primary bodies that devise Generally Accepted Accounting Principles. They are the Financial Accounting Standards Board, often referred to as FASB, F-A-S-B, and the Securities and Exchange Commission, often referred to as the SEC. There's a third body that is now coming on with additional power, called the International Financial Standards Board. And they issue something called International Financial Reporting Standards, known as IFRS. And in fact, all companies that are publicly traded by 2015 will have to comply with IFRS. GAAP, Generally Accepted Accounting Principles, will have to conform to IFRS. So the third principle, or the third objective I have for you, is understanding and knowing what Generally Accepted Accounting Principles happens to be. Now, your textbook lists out 4 accounting principles. They are the cost principle. The second one is the revenue recognition principle. The third is the matching principle. And the fourth is the full disclosure principle. I need you to know these 4 principles. In addition, your textbook lists out accounting assumptions. There are 4 of those as well. The 4 accounting assumptions are the going concern, the monetary unit, the time period, and the entity principle, or better known as the business entity principle, or business entity assumption, I should say. I want you to know these 4 assumptions. Now, the next objective is to understand the different forms that a business can take. A business can take a sole proprietorship, or it could be a partnership, or it could be a corporation. Now, in Accounting 201, we will only be dealing with sole proprietorships. In Accounting 202, we will look at partnerships and we will look at corporations. However, I want you to know each of these types of business entities. I want you to know what the liability of the owner happens to be, and if the entity is a taxable entity or not. So please know sole proprietorship, partnership, and a corporation. And the partnership, there are varieties of types of partnerships. We will only be looking at, in this chapter, a general partnership. The next objective is something called the accounting equation. Oftentimes, not mentioned in your book, but oftentimes it is referred to as the balance sheet equation. And that equation, you need to memorize that assets equal liabilities plus the equity of the company. Assets are the resources that the business owns. Liabilities happen to be the debts of the company. And the equity is the owner's interest in the company. So please know those items. Also know that equity is made up of the beginning equity of the owner, plus the revenues, less the expenses, less something called withdrawals. That's what the owner takes out of the business, and that gives you your ending owner's equity. You need to know what revenues are. Those are inflows, and you need to know what expenses happen to be. Now, the last objective in this chapter are knowing the different financial statements and knowing what goes on those financial statements. There are 4 financial statements we happen to have. There is the income statement, and I need you to know that revenues and expenses go on that statement. The difference between revenues and expenses is net income or net loss. And that statement is for a period of time. Think of it like your tax return. Your tax return shows your revenues and any deductible expenses over, say, a 1-year period of time. So the income statement is for a period of time. The next financial statement is the statement of owner's equity. It is also for a period of time, and you need to know that that period of time is the same period of time as the income statement. And as mentioned just a second ago, it shows your beginning owner's equity plus your net income, and net income is made up of revenues and expenses, less your withdrawals gives your ending owner's equity. So you will need to know that formula. The next financial statement is the balance sheet. In the balance sheet, we said there was a accounting equation, or known as the balance sheet equation. Well, it's known as the balance sheet equation because the balance sheet lists out the assets of the company, the liabilities of the company, and the revenues of the company. And on that statement, it must balance. That is, the assets must equal the liabilities and the owner's equity. The fourth statement, we will not actually be working with it in this course. We will look at it in Accounting 202. And that financial statement is the statement of cash flows. That lists out all of the inflows of cash and all of the outflows of cash. Think of it like your check register. Your check register shows all of the deposits you've made in your bank account. It lists out all of the checks you've written. So the statement of cash flow says, what are the total amount of cash I have received for, again, a period of time, and what are the outflows for a period of time. Those inflows and outflows are divided up into three categories: operating inflows and outflows, investing inflows and outflows, and financing inflows and outflows. And I would like you to know what goes into financing, what goes into investing, and what goes into operating. So those are the objectives we happen to have in chapter number 1.